Sometimes a stock that looks like it is really expensive is actually very cheap. And to understand when these instances exist is a very important aspect of being a great investor. Because when something looks optically like it's really expensive, other people won't be interested in buying it or doing research, whereas that can be your advantage. And so today we're going to talk about 4 different scenarios where this can happen. The first one is that there's a business with multiple segments, and one of the segments is profitable, while the other one is loss generating. This is very common actually, and it's happened most recently with just Google. One of the most well-known companies in the entire world, people would misunderstand their earnings power because they had Google Cloud, or GCP as the segment is called. While they were growing their cloud offerings, it was loss-making, which when you consolidated the two, reduced the profits that were reported. And so investors who are only looking at the bottom line of profits miss the fact that there was all of these losses from the cloud business embedded in the business. And so even if you didn't believe in at the time that they would ever really be profitable in cloud, which to be honest would have kind of been a silly assumption, but even if you did believe that, surely you wouldn't have believed they would lose money forever in it. And so what you are doing when you're combining a loss-making segment with a profitable one is you are basically saying that this company will continue to lose this money forever. And again, this is very common. People did this with Meta just a couple years ago, where they have the Reality Lab segment where they are spending a ton of money, almost $20 billion a year to develop augmented reality, virtual reality, and different AI-related products. Now, even if you don't believe anything is ever going to come from this investment, surely you don't believe they're going to lose $20 billion a year forever. But when you put a multiple on a stock with profits and losses combined together, that is essentially what you were saying. And that is because you could think about the same way when a company is profitable and you put a multiple on that and that creates value. If you put a multiple on losses, then you are saying that that value is basically negative forever. The same way you value profits by putting a multiple on it to get the total valuation of a business, you're basically doing the inverse when you put a multiple on losses. You are amplifying what that amount is, and it's basically estimating out that negative 20 billion continues to happen and discounting it back to today. And so that is a big mistake, because even if, again, nothing ever came from Google Cloud or all of Meta's VR investments, which again, I'm not saying is an assumption you should hold, but I'm saying even if that was true, surely they're not still losing money in these endeavors 30 years from now. And so when a segment is loss making, what tends to happen is either in a few years' time, the losses go away because they turn profitable, or they shut that segment down. Now, maybe there's some rare circumstances where that's not the case, but by and large, this is something you need to be on the lookout for an investor, because if profits are understated, then it is very likely there is more hidden value in that asset. Now, the next one is when a company is in an investment period. A lot of companies, when they're launching new products, they may not only see R&D be elevated, but also S&M. And at the same time, they may not have a lot of revenues associated with that product. And so if we think about CoStar Global, which is a real estate data analytics firm, they are known to buy different assets, such as apartments.com, and more recently, homes.com, and invest a lot of money in them in order to get them to grow. But there's this long period of investment. And in fact, CoStar today took sales and marketing to 50% of revenue. That is over 25% higher than what it has been historically. And all of that is because they are investing in growing this new brand in homes.com. But, and very important, this investment is not forever. Just like what they did with apartments.com, the idea is that once you get enough people to know about this brand, you don't need to spend this $1 billion on advertising anymore. Sure, maybe they're going to advertise forever, but it's going to be at a much lower level. And so all of this is them investing in the brand. Other companies may put a lot in R&D effort up front to invest in a new product, but once that product is made, they don't have to continue to put all of that upfront investment in it. You know, pharmaceutical companies, for example, once they develop a drug and it's developed, they're done. They don't have to keep developing the same drug. They'll develop different drugs, but if you're looking at that one specific drug, it's done. And so it is really important to catch when these companies are going through investment periods, earnings are going to be understated. The next important thing to look for is latent pricing power, or that is an ability for a company to take pricing up, which will not currently show in the income statement. LVMH, or Louis Vuitton Moet Hennessy, is known to raise prices basically every single year. And so earnings, in some sense, are a little bit understated because they have the ability to increase pricing. Hermes is an even better example of this because very often you could buy their marquee bag, a Birkin bag, and immediately sell it in the aftermarket for a premium. Now, they are very selective in who they sell people to for precisely that reason, but the difference between what they are selling their product for and what a customer can instantly get on a secondary market is a very good barometer of how much pricing power they have, and they have a lot. So if you're looking at Hermes today, you may say, oh, well, it looks kind of expensive, and maybe it really is. That's not the point I'm making. But what I am trying to say is that earnings could be much higher if they simply wanted them to be. They could go into the stores tomorrow and raise pricing 30% and have no issue selling out of all their product. Now, Costco is actually another great example of this. They are known to mark up their goods at only 13%. And so it doesn't matter what it is, they only mark them up at 13%, which tends to get them about a 2.5 to 3% operating margin. Now, this compares to Walmart, which is around 5%, and Target, which can be as high as 8%, but those can be volatile. Either way, though, clearly Costco is much cheaper. Could Costco go into all of its stores tomorrow and raise pricing 1%, 2%, 5% without seeing any sort of change in volume? It's pretty likely that they could. And since it's just a price increase, all of that would flow to the bottom line, almost doubling their margin. And that actually is an argument that an investor who goes by the name of Nick Sleep made a few decades ago when he invested in Costco. He tried to point out that Costco has a lot of this latent pricing power, and you should still value that even if today they're not exercising that price. And so if you were looking at Costco, for example, maybe 10 years ago or so, and you thought it traded at a 20-ish times multiple, and you realize, well, if they took that price, it'd really be a 10 times multiple, then you might have found that to be more attractive. That's just an example, though. There's many instances where a company has pricing power, and it's one of the most important things to look for because it's also a very good barometer on whether or not a company is high quality. The last one I want to get to is these one-time charges. And so businesses will pretty often, unfortunately, group a lot of expenses and call them one-time charges. Now, a lot of the times, these are kind of a little bit flimsy, whether or not they're really one-time charges or the business is trying to basically hide some expenses and use this as an excuse to get them out. And then a lot of times they'll use adjusted numbers and not include these one-time charges in the adjusted numbers. Okay, let's put that aside for a second. There are legitimate times where a company goes through some sort of transition and does genuinely have these one-time expenses that reduce earnings. And so again, if you're putting a multiple on this company and it's one-time charge, you're basically implying that this is going to happen forever, but it could go away next year. Now, some common examples are when there's a merger between two companies, there's usually some sort of write-down afterwards. That is not the best example of a time to say that that's a great opportunity because that usually means there was some sort of capital that was allocated poorly. However, some of the best one-time charges, and maybe you also kind of want to group these as like accounting charges that don't have real economic impacts, can be something like securities gains and losses. Berkshire Hathaway is now known for having these because they basically have to record whenever their stock prices go up or down and report it as part of earnings. But of course, if stock prices go down for a quarter, that doesn't actually mean the business is going to earn less money forever. It just meant that these stock prices dropped in price. And so that is a great time to adjust that out of the income statement because you want to get an understanding of what the true underlying earnings are, not what the change in the price of the stock price is that Berkshire Hathaway owns. And so those are the 4 things you want to be on the lookout for: grouping a profitable and a loss-making segment, companies that are currently in an investment period and so they're under earning, and companies with latent pricing power so their earnings are not as high as they could be if they wanted them to be higher. And then lastly is going to be any sort of one-time recurring or accounting distortions that are flowing through the P&L. Now, it's not just about these distortions that can exist, it's also about the quality of these cash flows and whether or not a business is high quality enough to protect them indefinitely. And so if you want to understand what makes a company great, make sure to check out this video here. And if you enjoyed this video at all, please go ahead and hit like and subscribe. And if you have any questions, drop them in the comments below.